This is Temple Fidel. Following is an animated illustration of the internal rate of return of convertible notes for convertible note investors. This presentation will not discuss the basics of convertible notes, such as the pros and cons of conversion discounts and valuation caps, but will propose a new way to protect convertible note investors' internal rate of return with what I call a risk-adjusted return floor. Most convertible note investors try to protect their risk-adjusted return by building in conversion discounts and valuation caps. These terms can be effective when the note is outstanding for less than 12 months, but do not account for the time value of money and do little to protect investors' returns in the 12 to 36-month time frame. Investors may think they are protected by having both a conversion discount term and a valuation cap term, but the reality is the next round investor investing in a $10 million pre-money valuation is not likely to let the conversion note investor convert at a $4 million pre-money valuation. This violates the golden rule. He who has the gold rules. I will first start with the internal rate of returns of conversion notes. The illustration will start with the IRR when the note has been outstanding 12 months. The note has an accruing 8% annual percentage rate, and the investors tried to protect the time value of money by building in increasing conversion rates at months 6, 12, and 18. Investors should not evaluate returns based on a discrete two-dimensional perspective, but should consider a third dimension of time. As you will see in this illustration, the risk-adjusted return deteriorates rapidly over time. I've calculated risk-adjusted return, or the internal rate of return, by calculating the compounded annual growth rate. As you can see, the conversion discount increased from 20 to 25% in month 12. This increase in the conversion discount causes a nice bump in the internal rate of return, but as you can see, it starts to deteriorate rapidly. Then in month 18, there is another bump from 30% to 35%, but the IRR then again starts to decrease rapidly over time. It's now entered into the range of 40 to 30%, drops below 30%, and starts heading down to below 10%. So by month 36, you are at 20% and decreasing significantly. The next illustration is going to be the internal rate of returns of convertible notes with a $4 million valuation cap. Again, we start with a two-dimensional graph, and we build in the third dimension of time. As you will see, the internal rates of return at the higher pre-money valuations in the earlier months are very attractive. However, as I mentioned earlier, it's very difficult to maintain that $4 million valuation cap conversion when investors are coming at significantly higher pre-money valuations. If you look closely at the graph in the upper left end of the curve, you'll see that there is even a significant deterioration in the internal rate of return, even at the higher pre-money valuations in the later months. The next and final illustration introduces what I call a risk-adjusted return floor. Most convertible notes are investments in early-stage companies when the investor and founders cannot agree on valuation. They decide to kick the valuation can down the road to the next legitimate round of equity financing. As mentioned earlier, investors try to be paid for the early-stage risk with discount conversions and valuation caps. They try to back into protecting their returns by protecting their ownership in the company. A more appropriate, and I believe defensible position, is for the convertible note investor to decide what risk-adjusted return they expect to receive for the risk they are taking. Is it 20%, 40%, 60%? Most VCs are expecting 60% IRR or greater. Investors should be explicit and contract the return they expect for their money. Instead of, or in addition to, conversion discounts and valuation caps, the convertible note investor should insist that the note convert at a value that has compounded on an annualized basis by their expected return. This term is a risk-adjusted return and provides a floor for the investor. For this illustration, I've used a relatively conservative expected return of 40%. As you will see in this first slide, I've overlaid the wire graphs of the discount conversion three-dimensional graph that you saw earlier and the three-dimensional graph of the $4 million valuation cap. I've also introduced the 40% risk-adjusted return floor. As you will see in the earlier months, it's still preferable to have either the discount conversion or the $4 million valuation cap. But soon, these returns of those two graphs actually dip below the floor, which as you can see is the dark green with the red outline. Then in month 18, the conversion discount gets a bump to 35%, which increases above the floor, but as you can see, starts to steadily decrease again below the floor. As the months expand, you can see that even the area that's been covered by the $4 million valuation cap curve also starts to decrease. And the range of IRRs that are protected by the risk-adjusted return floor of 40% becomes larger and larger, covering a wider range of possibilities that need to be protected. As you can see, in the later months, at the lower pre-money valuations, the risk-adjusted return term pays the investor appropriately for the early-stage risk they have taken. The risk-adjusted return may not eliminate the leverage of the golden rule, but it may provide investors a more reasonable and defensible position to negotiate from. When the next round investor shows up with the gold and says they believe a 40% return is too high, the convertible note investor should ask the new investor what sort of return they expect to get from investing in a later, less risky round. I would be surprised to hear VCs say that they are expecting a return lower than 40%. If they do, I would get on the phone and talk to some of their LPs. Thank you for your attention, and I hope you find this illustration useful.